It's Friday, you're watching Dukascopy TV and this is the weekly wrap-up. Joining me down the line to tell us what he thinks has been moving and shaking the market so far this week is Robbert van Batenburg. Robbert, February certainly had a bit of a turbulent start. Stocks were down, paradisical Peru was demoted to junk status, and all the while EM central banks continue to try to defend their currencies, somewhat unsuccessfully. But Robbert, how would you describe sentiment at present as we teeter on the brink of the first jobs data from 2014?
Well, the sentiment is, rife with uncertainty because, what's happening in the emerging markets, the trajectory of Fed tapering, its removal of quantitative easing, and of course, with the new chairman, with the new chairwoman succeeding Ben Bernanke, we don't know what her, whether there will be changes in the policy with respect to the stock market, with respect to the bond buying program, the way she envisions stimulating the economy could be quite different. So these are kind of the uncertainties, but I think the emerging markets here are probably most concerning to investors and are really spoiling the sentiment at this very moment.
Speaking of NFPs, some analysts are aiming high due to a bit of a return to normality after the cold weather, if nothing else. But what will really matter in the months ahead is if/when the pace of wage growth picks up. In this regard, the unemployment rate tells us almost nothing. After being hailed as the most important economic indicator for so long, is the significance of the jobs report dwindling? And what number are you looking for?
Well, the jobs number, it's difficult. There are two things that are in play. On the one hand, you have still erratic and not convincing hiring patterns amongst corporate America, but on the other hand, you have a lot of people that are leaving the labor force. So we're now at 6.7%. We could be at 6.5% as early as March. And it's puzzling to many why this jobless rate is going down so much, but it really has to do with an exodus out of the labor market. So even though the labor market seemingly still has a lot of slack, the underlying trends that have led to the decline in the unemployment rate could also perversely create some kind of upward pressure on wages in the next couple of months.
Thursday was Central Bank Day and it was more of the same from the Bank of England, Czech National Bank and the ECB. Since the ECB's previous meeting, the twin pillars of the central bank's policy, being CPI inflation and money supply, have drifted below the official targets. Analysts say the fact is, even though the ECB seems afraid of acknowledging it, that deflationary price pressures are becoming an increasing risk. What is your take on all of this?
In terms of the deflation, this is basically the same story as what's happening in the United States. If you have a stagnating labor force and you have productivity gains, then prices tend to fall. There's really nothing you can do about it. The same happened in Japan after the 1990s. The same is happening in Europe, where of course you have even much lower participation rates than here in the United States. You also have overall population growth is stagnant at best. So the labor force in both Europe and in the United States are now either flatlining or even shrinking. So you can't really do anything with that because it almost immediately implies deflation. So far, the ECB doesn't explicitly want to admit that, and although it expresses concern about downward pricing pressure, it doesn't really admit that it's currently in a deflationary trend, because should it admit it, then it also makes it more likely for the ECB to roll out another form of unconventional monetary stimulus. So this is where we are today.
Interestingly, the ECB's balance sheet is actually been contracting. This contrasts with the balance sheets of the Federal Reserve, Bank of England and Bank of Japan. With this in mind and with all that we've discussed so far, what is your outlook for the dollar against the single currency and the Japanese yen?
Well, like I said, it's a waiting game, so this can play out throughout the year, but it's well expected that the ECB will do something in the next couple of months. And if and when, we get more clarity on that, and this could also help, this could also be more clear if macroeconomic data point towards, further deceleration in price pressure, even more deflation. So then it also means a weaker currency, and, when we are in a similar situation back in 2012, the euro was somewhere between 125 to the dollar, so it's still relatively high vis-a-vis the dollar, and it's likely that over the next couple of months, I think that that's probably where the euro is headed. With respect to Japan, Japan has shown again straight resolve in wanting a lower value for the yen relative to the dollar and the euro. I think that will maintain. I think they will continue to put pressure on the yen. Their only problem is that if the emerging market crisis spins out of control or escalates, then it would actually mean that the yen will strengthen, because the yen is the ultimate risk on trade.
And just lastly, Robert, what events will you be keeping an eye out for next week?
Primarily her testimony on Tuesday and on Thursday. I think that's important. You have, some emerging markets will, on Thursday, for example, we have the Bank of Korea holds its monetary policy meeting. Indonesia, the same day, will also decide of interest rates. That's something to keep your eye on. And we have on Wednesday we have the UK's inflation report, and we have the industrial production out of the Eurozone. So I think these are kind of the things that we're looking for. Other than that, towards the end of the week it may get slow because you have President's Day next Monday, so the markets will be closed here in the United States.
Robert, thank you so much for your time today. Well, that's all from me for the moment, viewers, but Ben Jones will be back with an in-depth interview looking at those NFP figures, so make sure you click back for that. Goodbye for now.